All right, guys, so we had a great long weekend. Happy 4th of July to my American friends and happy Canada Day to my Canadians out there. Starting off with Virgin Galactic. So last week they announced they would send Richard Branson into space on July the 11th. That's next week. And the stock price spiked up to 57.50 or so last week before coming back down, closing at 45.20. Now, this is likely to be a sell the news event, although if it goes well, it's also possible it shoots to the upside. Now, right now it's very speculative and the implied volatility is very high. But looking at the option chain, we can see right now that, one second, let me pull it up, that for the July 16th OPEX, which is for next week, which factors in this event, the expected move on Virgin Galactic from the current price is about 12.50 in one direction from the current price. So upside of 57.50, downside of around 33.80 or so, or sorry, 32.80 or so, right? So a very wide range of possible values on Virgin Galactic. And, playing it is pretty speculative. Now, I do know a few people that really want to own the stock longer term. They think it's kind of like a Tesla. I do agree in certain respects. And here's where I agree, which is that if they do manage to pull off point-to-point travel on Earth at very, very fast speeds. So say, for example, traveling from Tokyo to Los Angeles or vice versa in half an hour, that would be pretty revolutionary. A lot of people that have deep pockets would be willing to pay for that kind of stuff because it would save a lot of time, obviously. And that would be where the future of travel would be heading, right? And over time, obviously, costs would decrease, and that would become a more mainstream form of travel, right? But we're talking about trading it in the shorter term right now. It is still very, very speculative. They have no revenues as of yet. That being said, if you do want to own the stock, a decent way to own it would be to sell cash secured puts. So for example, you can get, for the August OPEX right now, the 30 strike gives you about 250 credit, which means you'd be okay with owning the stock at 27.50, right? Now, what might be a decent idea if you wanted to own more than 100 shares would be to both sell a put for one position and then also buy 100 shares, right? Because then essentially you would lower your average cost on your 100 shares while also having the potential to own 100 shares more at 27.50. So for example, if you bought 100 shares right now at 45 and you sold a cash secured put at 30 strike for 250, that means your effective average price would be 45 plus 27.50 divided by 2, 36.25, or about $9 below the current price, right? So not a bad way to play it if you wanted to own it longer term. Upside certainly is in the 60s now. Downside, I would say, is back to 35, 30 perhaps, right? I don't think it'll go back below 30. The simple reason that they passed 2 new milestones in that they had their test flight, they passed that, and they got their FAA approval, right? So keep in mind that with each incremental achievement for a company with no revenue, the price floor will rise, right? Now the price floor is around $30, whereas before it was around 15, right? So with their first test flight going well, the price floor raised to about 25 perhaps, and then with FAA approval, now it's at around 30 or 35. With Branson going to space, that will be a proof of concept for a manned space flight with a civilian. So very, very cool. Obviously, first civilian in space, beating Bezos out by a few weeks. But yeah, again, very speculative. So keep that in mind. I do kind of like it if it gets back down to 35 or 30. I'm not going to be buying it myself here. I don't own any shares right now. I don't own any options on it whatsoever. I may trade it before the event, but again, it's very speculative in nature, and I prefer to be more conservative in times such as these where we're trading near all-time highs. Well, more on that later as well. So moving from Virgin Galactic now, we're going to go over to AMD, which I've been looking at for the past few weeks, right? Or a month and change, right? So I've been mentioning that AMD is poised for a major breakout now for a while. I mentioned that we were trading in that range between 75 and 95, and that at some point in time we would break above this range, pushing new all-time highs. Now we are on the cusp of hitting all-time highs, which are around 99.23, right? So we're only about $5 off there. Earnings are in approximately 3 weeks, and the stock is seeing some very bullish momentum over here, right? Nice volume buying to the upside, breaking out very clean. I do expect one more pullback, perhaps down to low 90s, perhaps 88 area before resuming its uptrend. But I do expect also that we're going to see 100 prior to earnings, and then a push up to perhaps 120, establishing a new range between 100 and 120 or so, which will then create a new range kind of like this, probably consolidate for a whole year again in a range kind of like this as well. And then it'll move up perhaps next year, sometime mid-year to around, 150, 180 or so, right? Again, the pattern I'm seeing here is that if you look at the chart, you can see that it established a range prior to this between around 60 and 40, right? And then it had a huge breakout to the upside, establishing a new range over here between 75 and 95 approximately. And now it'll establish a new range between roughly 100 and 120 or so, right? Right now, it isn't the best time to play AMD on options just because the implied volatility is very high. If you do want to play it, however, I would use spreads, right? Because look right now, a few weeks ago when I mentioned it, the IV was at 25%. So options were very, very cheap. I actually pulled up the implied volatility chart to show you how cheap options were. They were the cheapest they were all year, basically, right? This one, it was around 75 bucks, 77 bucks a share, right? Kind of puttering that little range. And now IV's at 42%. So buying options now is very expensive, right? You incur a lot more risk now because if it stagnates whatsoever, for a few days perhaps, you will lose, right? Keep in mind that for the past few quarters, AMD has rallied into earnings only to be sold off on the actual event itself. So another consideration there is perhaps to ride it into earnings, selling before the event, and then buying back in after the event occurs. Last quarter, it popped to 89 from around 80, and then it fell back down to 75 within a few weeks, right? But if you're going to trade AMD, I would do so longer term. You're trading with a shorter view. Sure, you might make a few bucks here and there, but I think the meat of the trade or investment rather will be in catching the move to around 120, which from the current price would be a gain of 25 over 95, a gain of 26% on the equity itself. If you were to buy leaps, for example, let's say you were to buy June 2022, so 1 year out call options. Let's say you bought in the money, for example, and you bought the 80 strike perhaps, right? These cost 23 bucks a contract. So break even is 80 plus 23, which is 103. This means that essentially you would incur a profit of about 100% in 1 year's time on your call options, assuming you're not selling contracts against your leap in the interim on shorter term expiration dates, trying to reduce your cost basis on IV spikes, right? So using calendar vertical spreads, right? Alternatively, if you want to be ultra bullish, you could also create a synthetic position long by selling a put option at the 80 strike, and then also buying the call option for 23. Essentially what that does is, if you look at the mechanics of the trade, if you build it right now, right? So long 80 strike, short the 80 strike put, right? So long 80 call, short 80 strike put. The cost of this trade is about roughly $15. 15 plus 80 is 95, which is roughly the current price right now. So this position will move almost in tandem exactly with the stock price, albeit you're using a fraction of the amount of funds required to buy 100 shares at the current price. So right now it costs about 9.5 grand to buy 100 shares. This position right here would cost you 1,500 bucks plus margin of about 500, so about two grand or so. So roughly about a fifth investment in the position versus buying the stock itself. Keep in mind, they don't pay a dividend. The one risk factor would be that if it pulled back down below 80, you need to be okay with owning it below 80, obviously, which you would be if you're going long at the current price anyway, right? So that's the whole idea, is that even if you bought the stock at 95 and it pulled back down to 80, you'd be down 1,500 bucks regardless. Same thing with the option. It's the exact same risk, roughly. The only difference being that you're risking, 1/5 the amount of money instead of risking, 9.5 grand on 100 shares. Obviously, if you don't understand what I'm talking about, do some more homework, ask more questions, understand intimately what you're doing before you do it. Don't just jump into trades because someone made a video about them and put them on YouTube, right? Again, I'm here to talk about these ideas, for my own journaling purposes, but also to kind of help you guys think through your own ideas as well. And so you can see how I think about my trading, right? Again, no one's perfect. I'm wrong very often as well. And it's important to just kind of evaluate every trade from every angle as well, right? So keep that in mind. Next up, we're going to look at Aapl as well, right? So Aapl had a great run last week, and they are pushing near all-time highs as well. Here is the 1-year chart. So I mentioned again a few weeks ago to go long on Aapl at around 125 because it had pretty much remained flat for roughly a year, even though their quarterly earnings have been phenomenal, right? And the opportunity that I saw there was that, of the FANG stocks, Aapl was lagging significantly, right? Now we've seen Aapl recover over the last few weeks. It has rallied now about 14%, and they report earnings in a few weeks as well, right? They're only about $5 off all-time highs. The IV is a little bit higher now as well. So looking at the chart here, you can see that the implied volatility on Aapl is 24% approximately, and the historical volatility is 15.7%, right? So you're going to want to look at using spreads if you are trading this, but keep in mind, a lot of the meat of the trade has already been missed. It's possible it pops to 150, 155, right? I do think it's going to all-time highs, but again, the risk reward here is not as favorable as it was when it was below 130, right? Looking now to August OPEX, because July is too soon. Even August is only 46 days away, so you're a month and a half out. You're approaching that 30-day period wherein the time decay increases much more rapidly, and therefore poses a much larger risk factor on any trade using a short-term time horizon, right? So you might want to look at August or even September, perhaps, if you're trading Aapl. I would go in the money versus out of the money because of the high implied volatility. But right now, if you are going to trade out of the money, spreads aren't a bad idea. So for example, let's say you went long 140s and short the 150s, you could risk roughly $3 and change to make about $7, right? So 2 to 1 risk reward roughly, break even of 143. If it's all-time highs and above, you pretty much double your money, right? But again, if it closes below 140, take maximum loss. And because it's a month and a half away, after the earning event occurs, IV will crush back down. If it goes down below 140, the contracts will trade for about $1.50 or so, or the spread will trade for about $1.50 or so, depending on how far down it goes, right? I mentioned last earnings that I prefer to wait till after the event itself to trade a given stock, and that still stands because you incur a lot more risk by buying options prior to an event. When the IV crushes back down, options become much cheaper, and you can buy stocks or options for very cheap after a phenomenal report. Like take for example, last quarter, Microsoft, AMD, Aapl, they all reported great quarters and they all fell. AMD fell from almost 90 to 75. Aapl fell from 130, 138, 139 down to 122 at one point, right? All of them got very, very cheap, very, very fast, and the implied volatility died down. And at one point in time, the July contracts on Aapl for July 16th were actually trading for about $1.40. Now they're worth $10 each, right? So if you're patient enough to wait for the pullback and the IV crush, you were rewarded very immensely. Obviously, if you bought the hype and paid for the high IV, you may have lost money or broken even, or cut your losses early, and at which point you lost when you may have won if you were patient, right? So that's my idea on Aapl right here is, perhaps be patient, wait for the ER if you're not already in it, because the IV is very high right now. If you are in it, I would just ride it out because, all-time highs are within reach right now, and it looks very, very good to the upside. Again, I think 150, 155-ish even on a good report is not without, is not a improbable event, right? So, but again, if you aren't in it, use spreads instead, right? Next up, we're going to look at, let me see, Micron, right? So someone mentioned Micron. They reported earnings last week. Again, great report. What happened? Stock price went from 85 down to $80. So case in point what I just mentioned was Micron last week reported they were 85-ish. They had a great report and they pulled back down to 80 or so, right? So anyone that bought call options or even put options perhaps because of the lack of a huge move may have lost on Micron last week, right? But now if it pulls back down to the 76 area again, which is their support, that would be an ideal place to go long, especially because the implied volatility is pulling back as well, right? So again, looking at the option chain here, we can see, excuse me, you can see right here, the option chain. And we can see that if you go out to August OPEX right now, the expected move for August expiration is about roughly 750. So upside 8750, downside would be around 7250, right? And the IV now is roughly the HV, which means that options are at their average price. Over the next few days, if as Micron stabilizes, the IV should come down even further, making options that much cheaper, right? But keep in mind, Micron was trading at around 90, 95-ish not too long ago, and it has the potential to push back up there. But if it does pull back to 76 area, that'd be a great area to buy on support, right? Now moving on to Microsoft, which is also requested as well. They have hit all-time highs recently too. And here's the chart. So again, I mentioned them when they were around 250-ish, and same pattern formation occurred last ER, right? So I mentioned over here that they pulled back down off of all-time highs on their previous earning report, came back down, consolidated for a bit, popped up again into their report. What happened? They reported over here, sold off again. This pattern right here looks almost exactly the pattern right here, right? So what do you think is going to happen over here? Perhaps consolidation in the 275, 280 range for a period of about 2 weeks, followed by earning report, fall back down again to around, let's say, 255-ish, and then push back up again, right? Possible we see the same pattern played out for the past 2 quarters. But again, they are at all-time highs right now. They're executing very, very well under Satya Nadella, the CEO, and they're firing on all cylinders right now. You know, great investment overall long-term. They are a behemoth of technology, and they'll continue to keep growing and growing and growing. And you know, I don't think that they're going to slow down for a long, long time, right? Moving on to Crispr stock. So I mentioned last week, Ntla, they had some phenomenal data come out last weekend. Stock price just rocketed this week, went from 90 last Friday, hit a high of 200, came back down to 164.55. IV is still very high right now. Their competitors also rallied hard on this news as well. So Editas, for example, they popped up from a low of 40 or so to 60, and then came back down to 55 or so again, right? I mentioned them last week as a corollary play or a sympathy play, if you will, on Ntla's report. And they had a very, very nice move. They moved almost 50% in a week, right? So that was a very beautiful play right there on heavy volume. Probable that it keeps on running to the upside to around 70, perhaps before a pullback. And then again, they have data coming out on their blindness solution. Should be coming out in September at some point in time. And if that is favorable data, again, I think you're going to see a very similar move in Editas as we saw with Ntla, wherein it shoots to 120, 140, 150, perhaps maybe even 200 again, right? That would eclipse the previous all-time high of 100, right? There's Editas, also Beam Therapeutics, same thing. They also took off last week as well, right? Nice big week. And then Crispr, of course, which is now second largest to Ntla in terms of market cap, right? So Ntla actually eclipsed Crispr last week on their massive run, right? Ntla is very, very interesting overall. Also to note that Jennifer Doudna, one of the co-winners of the Nobel Prize in biology for Crispr, she is going to be IPOing her second company as well. It's called, I believe it's called Mammoth. They focus on testing of diseases. Keep an eye on that as well. I'm not sure when that will be, but I'll probably be buying that if it's a reasonable valuation as well, right? So that's the Crispr space right there. Next up, we have Palantir, which I haven't discussed in a few weeks. They had a very, very nice pullback this past week or so, PLTR. right? So we can see over here that this chart doesn't show the full year because it's only about 9 months old now. There we go. So we can see right here that they hit a high of 27.44. Over the last 4 sessions, they've fallen down to 24.49. So the decline here has been about roughly not 12%. Let me zoom in a bit there, one sec. Second, guys. Remove this. So it's declined by about 11% in the last 4 sessions, right? And we're approaching a support area right around 23.50, 24, right? Keep in mind, earnings are going to occur in a few weeks as well. And I believe the earning date is, I think it's August 10th, if I'm not mistaken. Let me just check that for you guys. So it should be the week of August 10th, yes. No exact date that I have right now in my calendar, but you can confirm that obviously by looking at your calendars as the date approaches. But I do think this is a good entry point for anyone that missed the rally from the previous low of 17 up to 27.50 or so. Now the pullback down to 24.23 area is pretty nice for those who missed that rally, right? The implied volatility on it is, let me see it 1 second. Pull the option chain. PTR. It's at 49% right now, which is a bit high. And the historical is 43% right now, right? So looking at the options for August OPEX, we can see the expected move, which right now is about roughly $4 in one direction. So upside of 28, downside of 20. But keep in mind, they've been doing very well in their reports. They've been beating their earnings estimates, and revenues have been rising faster than expected as well. And I expect they're kind of sandbagging their earnings, and they're going to keep on outperforming. And if you look at any stock, any tech company that's done very well over the past 10 years or so, they've grown their revenues in a similar fashion to the way that Palantir has. And the nice thing is that when you're already at $1 billion plus in revenues, to a factor of doubling over a year means you're at 2 billion, then you're at 4 billion, then 8 billion. It can happen very, very fast, wherein within 4 to 5 years, they're doing 10 billion plus in revenues, which means that if you give them a multiple of, let's say, for example, 20x sales, that means they're trading at, let's say, for example, a valuation of $200 billion, right? So that could be 5x the current price, which would be around 125 or so. That's why you have to have a longer term view with these names. Trading them short term and making $3 or $4 or $5 on a swing trade, it's nice, but the reality of it is you're gonna make a lot more money on the longer term just buying and holding it when you're buying at a good entry point, right? So you want to be patient. I own some shares and I'll be holding them for the next 5 years at minimum, because I do believe that we'll see it push around 150, 200 bucks a share in due course, at which point in time I'm going to treat it like a rental property where I will sell covered calls against it at much higher prices, because once premiums inflate due to the price appreciation as well, you can make a lot of premium on a monthly basis off of a very simple position. So for example, let's say you buy 100 shares right now for $2.5 grand or so, right? In 5 years, it goes to 200 bucks. Now all of a sudden your investment goes from 2.5 grand to 20K. That means that over the past roughly 60 months, you've made a gain of about 17.5K. So 60 months, or sorry, 17,500 over 60. That means that you're getting about $300 a month for the next 5 years for doing nothing, right? On top of that, at that point in time, if you can sell, 0.2 delta calls out of the money for, let's say, for example, $3 or $4, which is not unreasonable a month out, you'll be making $400 a month on an investment that costs you 2.5 grand, right? Not too shabby. Extrapolate that across 500 shares, 1,000 shares, 5,000 shares. You get my point, right? So trading Palantir, same idea can be used, as I mentioned, with Virgin Galactic, wherein if you wanted to trade it by buying stock at the current price and then also selling a cash secured put at a lower price, strike price, for August, for example, like right now, not a lot of premium on the August puts, right? September puts, again, not a lot of premium overall, right? But perhaps you want to buy 100 shares, for example, at the current price or 24. Then you want to sell perhaps a cash secured put at 21. That means your effective buy price on that cash secured put would be around 21 minus 60 cents is 20.40, right? And that could be a decent average of around 22.50 or so to get in at, right? If it runs to 30 to 35, you're gonna be pretty happy that you got in. Keep in mind, the lower it goes, the better asymmetry of risk you have on the long side, right? That means that your risk is much, much lower, your reward is much, much higher, right? So manage your risk effectively. And keep in mind, guys, it's important to look at the broad market as well, because the broad market will also dictate where a stock can move in the short term, right? Right now we're at all-time highs. So any pullback of any magnitude whatsoever, it'll pull back everything, right? It'll pull back AMD, Apple, Palantir, Microsoft, everything, right? Perhaps some stocks lesser than others. Like for example, AMD is very strong right now. I think they'll keep pushing to the upside of 120, even if the market pulls back. But it may set them back down to 88 or 85 again, right? That would be a time to look at going long, perhaps, especially if the implied volatility is low, right? So decent ideas there to look at, right? Sorry, one sec, guys. And we have a few more names to go over as well. Let me just pull those up. So next up we have, oh yeah, that's right, Alibaba, right? So Alibaba had a nice pullback last week. So if you recall last week in our video, I mentioned that Baba would probably pull back down from that massive run up to 230 or so to the low 220s. It pulled back nicely on Friday. On Friday, it was actually very, very flat. Here's a chart for Friday, right? Kind of crazy to see. But it was trading pretty much between 217.70 and 217.90 for the last few hours of trading. Very, very flat trading. I haven't seen this kind of trading on a mega cap stock, I think, ever, where it stayed flat for 2 hours or so on a Friday. But given that there was some information that came out on the weekend on Didi Chuxing, which is the I may butcher the name, by the way, as well. It's the Chinese Uber, right? They IPO'd last week. This weekend, the CCP mentioned they wanted some, or they actually delisted them from the App Store in China. So the stock price got smacked. Interesting that they would allow it to IPO and then release that information, right? It makes you think maybe they're playing games right now to perhaps get at a better entry point. I'm not too sure why they would do that, but either way, it should hit Chinese stocks tomorrow. So JD, Baba, Baidu, they're all moving to the downside. And I think that, for those that have an appetite for risk, not a bad idea to nibble at these points, because there's a lot more upside than there is downside, in my opinion. Again, remember, this is risky, obviously. Most of these companies are just VIEs located in the Cayman Islands, meaning that you don't actually own anything as part of the company. You're trading the actual asset itself, but you don't actually own anything with respect to the company itself, right? So keep that in mind as well. I would trade it with options, not equity, just because, again, you want to have less risk dollar-wise if it goes against you. You should have it so that whatever you risk, if we're to go to, let's say, for example, Baba goes to $100, you wouldn't care at all, right? What would you not care about losing that you'd be willing to risk to perhaps make upside up to $250 or $300 a share if it were to run in the next few months, right? That's a question you need to ask yourself, right? Always consider the risk before the reward, right? Everything is about asymmetry of risk, right? What am I risking for what possible reward? Whenever you're risking a lot more to make a lot less, you need to step back, right? You always want to find opportunities that have far greater reward than the risk, right? And then control your risk. Take a small risk, not a large risk. Take risks that you can sleep with at night, right? If you're risking half your portfolio and it goes against you and you can't sleep at night, and your wife's going to give you the stink eye, you got to be very, very aware of that, right? And okay with your decision making. But most people aren't okay with that. So manage your risk very well. Only take risk of money that you can afford to lose, and understand asymmetry of risk as well, right? Again, buying more time is very important, and buying when IV is low is very important, as well as buying support levels, right? So looking at Baba right now, again, I'm gonna pull the chart out a little bit more, right? You can see over here, the high was around 320. Right now, we're near lows again of 210 or so. I expected this pullback down to 220 area. Might get one more pullback tomorrow, perhaps on the news from China, maybe down to 215 or 214 or so. Not a bad entry point if you're going long into August, September expiration. Keep in mind they have earnings as well right, in August too. So looking at the option chain now for Bubba, I'll pull it up right here. Here it is, right? So right now, the implied volatility, 27%, historical, 23%. IV is a little bit high, not super high, but it's still pretty high, right? So options are expensive. Looking at the August OPEX right now, the 220 calls about 865. Last week or 2 weeks ago, when it hit 210, they were trading as low as 570, right? After it popped at 230, they were trading as high as $16 each, right? So if you want to nibble, nibble in small amounts, I would say, right? And I would go out of the money versus in the money, just because if it makes a move, it'll make a big move to the upside. Downside, perhaps in the short term, is 190 or so, but I do think it's going to go to 250 again once everything stabilizes with the CCP. And again, I think it will, because why would they want to hurt their own companies in the public markets? It doesn't serve them very well, right? So have faith in your investments, but again, manage your risk. I believe it's going to go up. Am I risking? Am I betting the farm? No. Am I taking a risk that I can afford to lose? Yes. If I win, will it be substantial? Yes. Right. So ask yourself questions, be introspective, right? Evaluate your decisions, don't make impulsive decisions, and don't act on emotions, right? A lot of people were buying calls after it popped up to 230, not when it was down at 215 before, right? You don't want to be chasing things. You want to let them come to you, right? Just like you want, sell your house or buy a house, as it's running up, or maybe you would in Canada, perhaps when prices are going, to the moon, but perhaps you wait for a price that you're more comfortable paying instead, right? Just like with Bubba's stock, for example, right? You don't want to buy 250, you want to buy it 210, perhaps, right? You want to sell it maybe at 250, right? So think about that as well. And the last thing we're going to look at right now is the broad market. So we have SPY and Triple Q as well. So let me pull those up. And I just want to show you guys how extended we are now. So SPY has been on a pretty massive run the last year, right? Last year we pulled back from a high before the COVID dip. We were trading at roughly 340 on SPY, right? We pulled back down about 35% or so, right? And since that dip, we've now rallied 98% in the last year and change. From the previous all-time high, though, we are now up about 30%, right? Pretty substantial gain, and justified based on the Fed's actions right now of lax monetary policy. But you need to be cautious over here, because as we've seen, those that are greedy can get slaughtered, right? And right now, what we're seeing every single day, the futures market is kind of inching up little by little. I'll show you what I mean by that right now, just so you can see on the actual ES chart. Let me pull it up one sec. Find it. Here it is. Where's ES? So here's the ES chart right here, right? This is the features for the S&P 500, right? You can see right now that we're kind of inching up just little by little over the past few weeks. Let me pull up the past month, for example, right? So just, inching up little by little, each day gaining about, 0.2, 0.3%. But at some point in time, we should see a nice volatility inducing event where we get a nice pull back down, and we have a nice big gap to fill at the 400 area on SPY, right? So you need to be cognizant of this. I don't think it's going to happen anytime soon. I think it'll happen perhaps end of August, September. But again, you want to be aware of this as you are buying stocks at all-time highs, because the key tenet to success is a location of entry price, right? If you're buying at a high price, it becomes much harder to make money, right? If you're buying at a low price, it's much, much easier to make money, and your asymmetry of risk is much, much better, right? So, I'm not saying you shouldn't be buying right now, because if you're long right now, you can ride it perhaps a bit longer. But what I'm saying is that you need to be cautious and be aware that the market is overextended, and we are seeing euphoria where every company out there is IPOing, and basically, irrespective of their financial status or their business efficacy. And that to me seems a little bit bubblish, right? So I get kind of, hesitant. Right now, I'm 90% cash, so I'm very conservative. I'm anticipating on a nice big pullback in the next few months, but not before end of August, right? Again, I could be wrong. It might happen sooner, but I'm also positioned in a way that if it does happen sooner, I'm in a benefit, right? I'm not betting on puts. I'm not buying any options to the downside. I'm just writing my positions right now to the upside, but I'm also staying heavily in cash right now as well, right? So keep that in mind. This is the ES. I'm going to switch to Triple Q, which is the Nasdaq ETF. You can see as well, if I pull out further on the chart, you can see how far we've extended in just about a month and a half of time, right? So off that bottom right there, which everyone is worried about, again, I said, you guys, we've seen numerous dips in the past year. We've seen, a dip over here, nice dip over here, nice dip over here. What happened every time? Rally back up. But right now, we'll probably see a pullback down to around roughly maybe 330, maybe 320 on SPY again, right? That at that point in time, it'll be a very, very nice entry point on a lot of names, right? So be patient, wait for your entries. Don't chase into positions on FOMO, right? Remember that there are always opportunities in the market, right? To be very patient to get the best opportunities. If you jump the gun and you lose money, typically speaking, you're gonna be very emotional about it. You're gonna be very hesitant to act on new positions that may be more favorable to you, which means you're gonna miss opportunities out, right? That happened last March when the market pulled back. People that were fully invested didn't want to buy more because they were so scared, right? Obviously, everyone thought it was going to go down further, but what happened? We rallied almost 100% on SPY since last March, right? So be very careful, manage your risk very well, talk out your ideas. I also recommend journaling your ideas as well, right? If you write them down and they don't make sense to you, or you can't think of reasons why you're buying a given position, you shouldn't be doing it, right? Buying something because someone else is doing it is not a good decision, right? Don't listen to me, don't listen to someone else, listen to yourself. Find your own thesis on a certain trade, explain it to people that are perhaps more educated in the markets than you are, get their feedback, and listen to counter perspectives, because again, the best decisions that are made are based upon numerous perspectives, not one perspective, right? If you're too bullish, you might be wrong. If you're too bearish, you might be wrong. But if you have both angles covered, you can see where your deficiencies lie in your overall thesis, which means that you may pair your risk a bit or manage your risk better by, using a combination of puts and calls, perhaps to hedge your position in certain ways, right? Now we'll move on to the Q&A. I'll stop recording here, guys. If you enjoy the video, like it, whatever, share it. I don't really care, honestly. I'm not a big YouTuber at all, but have a great week, manage your risk well, and we'll do some Q&As right now.